Stop, right now. Gold just closed Friday at $4,493. Silver at $69.62. And if you just watched gold surge to $5,000 and then pull back, I need you to do nothing else but sit down and listen, because what is happening in the global gold market right now is not a correction, not profit-taking, not a technical rejection at resistance, not algorithms reacting to a stronger dollar. That's the story they want you to believe, but the reality? We are witnessing something that has never happened in modern market memory. And the reason you're not hearing a clear explanation is because most financial channels are measuring the wrong data, asking the wrong questions, and looking at the wrong charts. In other words, they're trying to explain a system that is changing, with tools from a world that no longer exists. You're being told that gold is weakening, that nations are selling because better opportunities exist. Wrong. The entire system is forcing them to sell, not because gold is losing value, not because a superior asset has emerged, but because the global financial system is holding a gun to their head, and the only bullet in the chamber is gold. Turkey, 58 tons of gold in 2 weeks. Not rebalancing, not strategy. That's crisis behavior, like someone drowning, throwing everything overboard just to survive. The Gulf states, quietly shifting reserves, flowing into bullion vaults in London. No announcements, no confirmation. But the data doesn't lie. Russia, $30 billion in gold, sold in 2025. And then immediately after, a large-scale export ban. A move almost no one understood at the time it happened. And China, the most consistent sovereign buyer of gold, has gone silent. Exactly at the moment, when the wave of selling peaks. These are not isolated actions. This is a signal that, if you're only watching price, you will miss the entire story. The largest buyers in the world are stepping back. At the same time, the largest sellers are showing up. Not random, not coincidence. And here's the only question you need to hold in your mind, because this entire video revolves around it. When the sellers are forced to finish selling their gold, what happens next? I'm going to answer that, clearly, precisely. But you won't understand the answer unless you can see the full structure behind this wave of liquidation. Because this is not one force, not a single crisis. This is 3 completely separate forces, pressing on the same market at the same time, for completely different reasons. And that overlap is what turns this moment into the most important gold event of the decade. Stay to the end. Because what happens after forced liquidation is finished is not just the next phase of the market, it is the context that financial history will have to rewrite. 3 forces are simultaneously pressuring nations to sell gold. Not one crisis, but 3 different crises, operating through 3 different mechanisms, driven by 3 different actors. The first force, energy-shocked nations, dollar inflows collapsing, obligations still intact, and gold becoming the final lever. The second force, dollar-pegged economies, especially the Gulf, where stability depends entirely on oil flows, now disrupted. The third force, war-financing states converting gold into capital, while building financial systems outside the dollar. These 3 forces are creating the most concentrated wave of gold liquidation in modern history. But here's the part most people miss. Each force has a limit, a point of exhaustion. And when it ends, the gold that has left the hands of forced sellers will not return at these price levels. To understand why, you need to understand one concept: a margin call at the national level. Think of each country like a water tank. Inflow is dollars from exports. Outflow is financial obligations. When war collapses the inflow, but the outflow remains, the system has no choice. They don't want to sell gold, but they are forced to. When dollar inflows collapse, but obligations remain, the system begins draining from both ends. And that's when a margin call at the national level is triggered. Governments don't have many options. Either let the currency collapse, triggering hyperinflation, or burn through dollar reserves, only delaying the outcome, or sell the most liquid asset to buy time. That asset is gold. And here's the mistake retail investors are making. They see nations selling gold prices falling and assume confidence in gold is disappearing. Wrong. 2 types of selling look identical on a chart. but the cause is everything. One is a loss of confidence. The other is forced selling for survival. What you are witnessing does not say gold is weakening. It says the system is under extreme pressure. The nations selling today will be the ones buying tomorrow. And while they are forced to let go, those who understand this structure are quietly accumulating. This is not the collapse of gold. This is a transfer from those who cannot hold to those who have no intention of selling. The entire fixed exchange rate system of the Gulf is built on a single assumption. Oil flows, dollars flow, the system stays stable, and for decades that was true. But when the Strait of Hormuz is choked, 20% of global oil supply is disrupted. Dollar inflows don't decline gradually, they collapse. Meanwhile, obligations remain. Food imports, military spending, capital outflows, and so an invisible force of gold selling emerges. Not Turkey, visible, but Gulf sovereign funds, disciplined, silent, unannounced, no IMF reporting, no public confirmation. But the London vault data doesn't lie. Gold is flowing out. At the same time, Russia creates the third shock. $30 billion in gold has been sold. Then suddenly, a large-scale export ban. The result? A race to liquidate ahead of the cutoff. Gold flooding into the market in an extremely short window. Three forces, three different motives, one outcome. Supply surges, exactly when the largest buyers go silent. But here's what matters. Gold isn't disappearing. It's changing hands. From those who are forced to sell, to those who are patient enough to wait. The ones buying right now are not short-term traders. They're not chasing charts. They understand exactly what they're buying and why. Meanwhile, the ones selling, they're not selling by choice. They're selling because they are forced to, and that's where the opportunity appears. Assets are transferring from those under pressure to those with time. And once that transfer is complete, that supply will not come back. I know how this feels right now. Gold pulling back slightly from the highs. Silver correcting, if you're holding. The discomfort is real. But look at the structure. None of the core drivers of this bull market are broken. Not the deficit, not the dollar trend, not mining supply. The only thing that has changed is a set of emergency conditions forcing certain players to sell. And all emergency conditions have an endpoint. Meanwhile, this market has risen over 100% in just a few years. A small pullback is not a reversal. It's a test of conviction. And history shows, every time the market runs this test, it doesn't get weaker, it gets stronger. When the forced sellers run out of gold to sell, what happens next? Every force has an endpoint. The oil shock? It doesn't last forever. When dollar flows recover, Turkey, India will return as buyers. They didn't change strategy. They just survived. The Gulf states, the selling is tactical. When flows stabilize, they will quietly accumulate again, the same way they sold. Russia, the wave of selling has a limit. And when it ends, Russian supply is pulled from the global market. Three forces end, supply disappears. But the real story is on the other side. The US deficit is still expanding. Money still has to be printed. Growth will slow, and when it slows enough, rates will fall. And when rates fall, the cost of holding gold disappears. That's not theory. That's a pattern repeated throughout history. At the same time, the world is shifting away from the dollar. Russia, China, building new systems. Gold demand, not falling. It's being accumulated. So understand this clearly. This is not a collapse. This is temporary liquidation inside a structural bull market, the strongest we've ever seen. The world's largest buyers have stepped back at the worst possible moment for price. But when they return, China, Poland, the Gulf states, they will enter a market where forced sellers no longer exist, and that is the turning point. I can't give you exact timing. If Hormuz worsens, price could drop to $4,200, even $4,000. But to break this bull market, you would need to reverse monetary policy, geopolitics, and supply. The data is clear that hasn't happened. What the data does show is this: forced sellers always run out. Patient buyers are always rewarded. And the current setup, forced liquidation plus strategic accumulation plus currency debasement plus rates set to reverse, that's not the end. That's a reset. And the reset is happening right now at 4,493,000. Three forces are driving everything. First, the oil shock. Turkey, 58 tons in 2 weeks. India, selling for the first time in years. This force ends when energy stabilizes. Second, dollar-pegged nations. The Gulf, 45 tons flowing through London, unconfirmed. An invisible force, but disciplined. It ends when reserves stabilize. Third, war financing. Russia, $30 billion in gold, then an export ban. A preemptive liquidation wave already self-exhausting. Meanwhile, the largest buyers have paused. But remember this: forced liquidation always has limits. Currency debasement continues. Real rates will fall. And when the buyers return, they will be buying into a market with no cheap supply left. This is not the end. This is the reload. And if you understand this, you're not just watching price. You're seeing the structure.